The Schwab U.S. Dividend Equity ETF trademark, or SCHD, is not your run-of-the-mill high-yield exchange-traded fund. In fact, it's a cherished 5-star gold-rated investment vehicle, often referred to as the gold standard of high-yield ETFs. While there has been some debate over selling this ETF due to concerns about its slower growth in the future and its valuation, I'm here to provide 10 compelling reasons why SCHD isn't just undervalued, but also presents a Buffett-style fat pitch opportunity. To delve deeper, Schwab U.S. Dividend Equity ETF trademark, or SCHD, is widely respected among income investors for good reason. Yet there are those who hold a bearish outlook on this investment, even recommending selling it and moving to cash with its 5.5% yield. I'm here to debunk the 10 most prominent bear market claims, reaffirming that SCHD is not just a 3.7% yielding income source, but also a Buffett-style fat pitch buy. Here's why you should be considering investing in this gold standard high-yield ETF. First, let's clarify a crucial point. Stocks are not a substitute for cash. If someone tells you otherwise, they're either uninformed, dishonest, or trying to sell you something, possibly all three. Consider the data. Historical cash investments typically yield between 0% and 2% in long-term real returns. In contrast, stocks have historically generated 6% to 7% returns since 1800. This means that $1 invested in U.S. stocks in 1800 would be worth $3.6 million today, adjusted for inflation, while the same amount invested in cash, T-bills, would only amount to $44.83. That's a staggering 4,000 times better return with stocks compared to cash. However, one might argue that not many people have a 200-plus year investment horizon, aside from historical figures like Ben Franklin with his unique invest-to-give strategy. In the real world, investors typically don't hold for centuries. So let's dig deeper into the reasons to consider SCHD, especially for those who are looking to build wealth over a more typical investment horizon. Nick Maggiulli, the Chief Data Scientist and Chief Investment Officer at Ritholtz Wealth Management, is part of an all-star team in the financial world that includes notable figures like Barry Ritholtz, Ben Carlson, and Michael Batnick, among others. These individuals are widely respected financial bloggers and influencers, particularly within the hedge fund industry. It's not just that they provide valuable insights, they also rely on data and charts meticulously collected and organized by Nick Maggiulli. Maggiulli's research has consistently reinforced a fundamental investing truth. Stocks have historically been the best-performing asset class in history. Furthermore, his findings support the idea that buying stocks as soon as you have the money available has been one of the most effective investment strategies for much of the post-World War II era. In the realm of perfect market timing, the reward is about 22% higher returns over a 40-year period without accounting for taxes. This 22% doesn't refer to an annual return, but rather a cumulative benefit over 4 decades. In simple terms, it's about gaining an additional 0.5% in annual returns, assuming no taxes. His research also demonstrates that throughout the years since 1960, including the turbulent times like the stagflation era of the 1970s, a portfolio mix of 60% stocks and 40% bonds outperforms holding cash. Looking at the modern era from 1997 to 2020, U.S. bonds have consistently underperformed, making an argument for buying stocks about 90% of the time. One might wonder if Maggiulli's data is skewed to promote a pro-stocks agenda, particularly given that he's the author of a book titled Just Keep Buying: Proven Ways to Save Money and Build Your Wealth. This book is considered by many to be an excellent fact-based guide to sound long-term investing. However, his findings are based on a wealth of historical data from 3 different countries spanning 160 years. This extensive dataset firmly supports his conclusions. About 70% of the time, the optimal choice is to invest in stocks as soon as you have available funds. This approach can potentially yield 2.4% higher average annual returns over time and lead to 104% more wealth, adjusted for inflation, over 30 years. Let's put this into perspective. Imagine having $500,000 saved for retirement, which, under the 4% rule, would provide you with an annual withdrawal of $20,000. Now consider what life might be like if you had $1 million saved, granting you a comfortable $40,000 annually. An extra $20,000 in retirement income could significantly enhance your standard of living. So while some may be skeptical, the data and research, even beyond the work of Nick Maggiulli, repeatedly underscore the potential long-term benefits of investing in stocks, making a compelling case for individuals to consider this approach for their financial future. If there's one thing financial experts, including JP Morgan Asset Management, agree upon, it's this: market timing is a fruitless endeavor. The research conducted by Bank of America reinforces this, emphasizing that attempting to time the market can be a surefire way to sabotage your retirement savings. A striking example of the hazards of market timing comes from the simple act of missing the 10 best single market days in each decade, which averages out to just 1 day per year. Surprisingly, this seemingly minor blunder can transform the market's remarkable long-term gains into a staggering 94% loss when adjusted for inflation. To put it plainly, envision investing your hard-earned money for 9 decades only to witness 94% of your purchasing power evaporate. It's not just a dent in your retirement dreams, it's a full-blown demolition. Now consider the implications for anyone contemplating selling the SCHD ETF with the intention of purchasing it later at a cheaper price. What this approach amounts to is essentially an endorsement of market timing, despite the overwhelming evidence against it. However, skeptics might argue that the likes of Ritholtz, JP Morgan, or Bank of America are not to be trusted. Here's where the findings of the investing research company Dalbar come into play. Their research echoes the same fundamental principle as all the others. It's about time in the market, not timing the market. This philosophy is not just espoused by financial experts. Legendary investors such as Ben Graham, Warren Buffett, Charlie Munger, John Templeton, Peter Lynch, Joel Greenblatt, and Howard Marks all rally behind it. Let's say, though, that you remain wary of legendary investors and question the integrity of the research conducted by Ritholtz, JP Morgan, Bank of America, or even Dalbar. Enter Charlie Bilello, a conservative financial advisor who arrives at the very same conclusions as his peers, and not just once, but time and time again. In essence, the message is clear. Anyone asserting that cash and stocks are direct competitors is disregarding the facts. The prudent approach to managing your finances involves a well-thought-out asset allocation based on your financial goals and time horizons. Money you need soon, keep it in cash. This includes funds you might need within the next year or two. Short to medium term, for a financial horizon of 3 to 4 years, consider medium-duration treasury bonds. Long-term investments. For money you won't need for 5 years or more, a more aggressive portfolio is suitable. This typically has a significant focus on stocks, perhaps adhering to a classic 60-40 allocation or a more aggressive strategy like Buffett's 90-10, or even going all in with 100% stocks if you have a long investment horizon. As for SCHD, it's crucial to understand that it isn't a substitute for bonds. In fact, no stock can truly be considered a bond alternative unless it represents a company with no growth prospects whatsoever. As data reveals, cash investments haven't surpassed the returns delivered by SCHD or the broader stock market over the past dozen years. This underscores the fact that assets like SCHD, which primarily invest in dividend-paying stocks, offer a unique value proposition and are not to be confused with the objectives of bonds or cash equivalents. SCHD's dividends are tax-friendly. The tax implications of your investments is crucial. While bond income is taxed as ordinary income, SCHD's qualified dividends enjoy a better tax treatment. For most Americans, these dividends are taxed at a rate of 15%, which, for comparison, is significantly lower than the average American's tax rate of 24.8%. This means that interest from cash investments is taxed at a rate 10% higher than SCHD's dividends. SCHD's dividend income risk is lower than Treasury bills. SCHD's track record of maintaining dividend stability is impressive. It has never faced a dividend cut, which is in stark contrast to cash yields. Cash yields tend to decline as the Federal Reserve cuts interest rates. Unless you believe the Fed will maintain rates at their current levels indefinitely, SCHD's dividend stability remains much stronger compared to Treasury bonds, which are virtually guaranteed to yield less at some point in the future. SCHD's growth potential is strong. Over the past decade, SCHD has exhibited a historical earnings growth rate of 9.6% from 2011 through 2022. Although this growth rate is expected to slow from 2022 through 2025 due to the projected recession in 2024 or 2025, SCHD is anticipated to maintain a growth rate of 7.9% through 2025. This growth is significant, especially when compared to the FactSet consensus of 8.5% for the S&P 500. Suppose we entertain the idea that SCHD's growth rate might slow down in the future. Even if we assume a conservative 6% growth rate, its current 3.7% yield combined with this growth rate would translate to a solid long-term return of 9.7%. This return is comparable to the S&P's returns, but it comes with the advantage of 40% of returns stemming from cash payments rather than relying solely on riskier growth. SCHD is a valuable investment. The assertion that SCHD is overvalued is contradicted by the facts. In reality, SCHD is trading at a cash-adjusted earnings multiple of 9.5x, which is a remarkable 25% discount to SCHD's market-determined fair value. Moreover, the private equity sector is currently willing to pay 11x cash-adjusted earnings, which makes SCHD a compelling investment, trading at a 14% discount compared to the deals billionaires are securing. In summary, SCHD exhibits strong potential for returns. If we consider the short-term growth rate of 6% and its current 3.7% yield, this adds up to a long-term annual return of 9.7%. Even with conservative growth expectations, SCHD can still triple your investment and surpass the S&P's performance over the long term. If we lean towards Morningstar's analysts' expectations, which anticipate 10.5% long-term earnings growth, the future becomes even more promising, with the potential to outperform the S&P by a substantial margin. In essence, SCHD is far more than just its 3.7% yield. It is a highly regarded ETF, backed by Morningstar's 5-star gold rating for its consistent performance. Over the past decade, it has consistently ranked in the top 3% for post-tax returns among its peers, and the top 2% for pre-tax returns. Furthermore, Morningstar foresees SCHD continuing to deliver impressive long-term returns of around 14% to 15%, which is almost 5 times what the S&P 500 is expected to provide in the next decade. Essentially, Morningstar envisions SCHD tripling the market's returns through 2033. Moreover, FactSet's short-term growth estimates suggest SCHD may triple your investment within the next decade, surpassing the S&P. In the shorter term, SCHD presents the potential for 3 times the market's consensus return over the next 2 years, coupled with a compelling 15.5% valuation boost. If you're contemplating SCHD as an investment, the data and analysis strongly indicate that buying now at 13x earnings is a wise move, with a 97% confidence in its long-term success. Even in the shorter term, there is an 80% statistical certainty that those who invest in SCHD now will be satisfied with their decision over the next 5 years.